Tax strategies the wealthy use, but nobody ever talks about. Let me tell you something that took me years to fully understand, and that most financial educators will never say out loud. The wealthy do not avoid taxes by earning less. They reduce taxes by owning more. They use the same tax code that is available to every American, but they understand it in a way that most people simply do not. And that knowledge gap is costing the average mid-career professional tens of thousands of dollars every single year. Today, I am pulling back that curtain. We are talking about the legal IRS-approved strategies that high net worth individuals and savvy investors use to keep more of what they earn, and how you can start applying them right now, even if you are not wealthy yet. Because here is the truth. It is not just about how much you make. It is about how much you keep. And keeping more starts with knowledge. Hi, I'm Coach Lee. Let's talk today about taxes, the way nobody else will. For educational purposes only, consult a tax professional for your specific situation. Subscribe and hit the bell right now. This is the kind of content we bring every single week, and share this video because this information is just too valuable to keep to yourself. Let's get into strategies. Let me give you a mindset shift that changes everything about how you look at your tax bill. Most W-2 employees have almost zero control over their taxes. Their employer withholds, the IRS takes its share, and whatever is left is what hits your bank account. For the majority of Americans, that is their entire tax experience, and it is very expensive. But the tax code is not written for W-2 employees. It is written for business owners, investors, and entrepreneurs. The deductions, the credits, and the strategies embedded in the code are overwhelmingly designed to reward people who deploy capital and create economic activity. The more you operate like an investor and business owner, even alongside your career, the more access you have to those rewards. This is not a loophole to abuse. This is reading the instructions. The IRS wrote these rules into the code deliberately to incentivize investment, home ownership, business creation, and job growth. Using them is not cheating. It is participating in the system the way it was designed to be used. Hear me clear. The wealthy don't pay less in taxes because they cheat. They pay less because they understand the rules better than anyone else, or they hire the right professionals. How much did you pay in federal taxes last year? Drop it in the comments. Not to embarrass yourself, But as a wake up for yourself, that number is your motivation for the next 10 minutes. If you have been following this series from week 3 and week 7, you already know I am a passionate believer in real estate as a wealth building vehicle. But one of the most underappreciated reasons to own investment real estate is the extraordinary tax advantages it provides. Let me walk you through some of the bigger ones. Strategy number 1, depreciation. When you own a rental property, the IRS allows you to deduct a portion of the values for the property every single year as depreciation, as if the building is wearing out over time. For residential rental properties, that depreciation period is 27 and a half years. On a $275,000 property, that is $10,000 a year in paper deductions, even if that property is actually appreciating in value. That's $10,000 reduced from your taxable income without costing you a single dollar out of your pocket. Strategy number 2, cost segregation. This is the strategy that separates sophisticated investors from mere beginners. A cost segregation study breaks a property down to its components: flooring, appliances, landscaping, electrical systems, and accelerates the depreciation on those components from 27.5 years to 5, 17, or 15 years. The result can be a massive depreciation deduction in year 1 that shields not just the rental income, but potentially a significant portion of your W-2 income as well. This strategy is typically worth pursuing on properties valued at $500,000 or more. Strategy number 3, the 1031 exchange. When you sell an investment property, you would normally owe capital gains tax on the profit. But with a 1031 exchange, named for the section 1031 of the tax code, you can defer your taxes indefinitely by rolling the proceeds into a like-kind property within a specific time frame. Done correctly and repeatedly, a 1031 allows you to exchange and trade up to larger and more valuable properties over your lifetime while continuously deferring the capital gains that would otherwise erode your returns. Strategy number 4, the real estate professional status. This is the most powerful and most misunderstood real estate tax strategy available. If you or your spouse qualifies as a real estate professional under the IRS rules, your rental losses can offset your active W-2 or business income with limitations. The qualifications require spending more than 750 hours per year in real estate activities and more hours in real estate than any other profession. It is not achievable for everyone, but the right household, it can result in tax savings of tens of thousands of dollars per year. Consult a CPA who specializes in working with real estate investors to evaluate your eligibility. Depreciation is the greatest legal tax shelter available to individual investors, and most people have never heard of it. Remember, I told you here. If you own a business, have a side income, or are self-employed in any capacity, even as a consultant or freelancer, you have access to a powerful second layer of tax strategies that W-2 employees simply do not. Strategy number 5, the solo 401k. If you have any self-employment income, even on the side, you can open up a solo 401k and contribute up to $69,000 per year in combined employee and employer contributions as of recent limits. That is contributions that reduce your taxable income dollar for dollar. For those professionals in a high tax bracket, the annual tax savings on a maxed solo 401k can reduce your taxes by 20 or more. This is one of the most underutilized retirement vehicles available. Take advantage. Strategy number 6, business deductions. When you operate a legitimate business, a wide range of expenses become tax deductible. Heard about your home office, your vehicle used for business purposes, professional development, coaching, software, marketing, travel for business purposes, and more. These are expenses you may already be incurring. The difference is whether they are being properly documented and deducted. A qualified business CPA will find deductions that most people leave on the table year over year. Strategy number 7, health insurance deduction for the self-employed. If you are self-employed and pay your own health insurance, 100% of your premiums are deductible from your adjusted gross income. For a family paying $1,500 per month in premiums, that is an $18,000 annual deduction. This one is frequently missed by freelancers and entrepreneurs who do not work with a tax professional who knows where and what to look for. Strategy 8, qualified business income deduction. Under current tax law, many business owners and self-employed individuals can deduct up to 20% of their qualified business income from their taxable income. This deduction, known as the QBI deduction, was introduced to give small business owners a huge tax advantage comparable to the corporate tax rate deduction. Not every business type qualifies, and income limits do apply. But for those who do, it is a significant annual benefit. A good CPA specializes in working with investors and entrepreneurs is not a cost. They are one of the highest return investments you can make. So get your tax strategy today. Finally, let's talk about the tax advantages built into investment accounts themselves. Because where you hold your investment also matters as much as what you are investing in. Strategy number 9, max your tax advantage accounts first. Before you put a single dollar into a taxable brokerage account, you should be maximizing your 401k, your Roth IRA, and if eligible, your HSA. The tax-free or tax-deferred growth inside these accounts is one of the most powerful compounding advantages available. A dollar that grows tax-free for 20 years is worth dramatically more than a dollar that is taxed annually on its gains. Strategy number 10, the Roth conversion ladder. If you are planning for early retirement, as we discussed in the FIRE episode, the Roth conversion ladder is a strategy worth understanding. It involves systemically converting a traditional IRA or 401k funds to Roth accounts during lower income years, paying tax at the lower rate now to access tax-free income later. Executed correctly over a 5-year window before early retirement, it can provide a tax-efficient income stream that bridges the gap before traditional retirement accounts at 59 and a half. Strategy number 11, tax harvesting. In a taxable brokerage account, you can sell investments that are currently at a loss to offset capital gains elsewhere in your portfolio, reducing your tax bill in high income years. The proceeds are immediately reinvested in a similar but not identical investment to maintain your market exposure. Many robo-advisors and sophisticated brokerage platforms now automate this process for you. Over time, tax loss harvesting can add meaningful after-tax returns to your portfolio. Remember, it is not what you earn, it is not even what you save, it is what you keep after taxes. That is the number that builds your wealth. And remember, you heard that here from Coach Lee. Here is your action step for this week. And this one could save you thousands of dollars. Find a CPA who specializes in real estate investors and small business owners, not a general tax preparer, and not the software you use every April. A tax specialist, and interview at least 2 before you hire one. Ask them specifically about depreciation, cost segregation, the solo 401k, and QBI deductions. These answers will tell you immediately whether they are the right fit for you. The right tax professional is not an expense. They are an investment that typically pays for itself many times over in the first year alone. You do not want to delay this one. Drop a comment. Which strategy from today surprised you the most? I want to know what was new information, and please share this video because tax knowledge is wealth knowledge, and most people are losing thousands every year simply because nobody showed them what they were missing. I'm Coach Lee. The wealthiest people in the world do not just earn differently, they keep differently. Now, you know how as well. This information in this video is for educational and informational purposes only and does not count as tax, legal, or financial advice. Tax laws are subject to change. Please consult a qualified tax professional, CPA, or financial advisor for advice that's specific to your individual situation. I'm Coach Lee, signing off for this week.